Hello again, everyone. This is Mario Nardone. Hope you're all enjoying your summer, and welcome back for the second quarter 2018 market and economic overview. Today we're going to get right into it and first take a look at some pros and cons at a very high level about what's going on in our economic environment. Many of our client questions and concerns come from the extreme ends of the optimist-pessimist spectrum, and it's our job to keep attitudes somewhere in the middle. So here are some cases for either view. On the positive side, we have seen extremely strong growth here in the U.S. That's exemplified by a strong labor market, inflation finally around the levels that the Fed has targeted, and the economic expansion here has probably been a bit prolonged by our policy stimulus. Looking at stocks, we do know that stocks often perform well when economic growth is solid, especially perceptions of continued reasons for optimism. Also, whereas some folks might look at rising interest rates as a negative for stocks, because we're coming off such a low base, that actually has been a harbinger of decent stock returns when the situation has been prevalent in the past. We see emerging markets still in the early stages of their recovery, and for the long-term perspective, with aging populations in much of the developed world, emerging market economies can really be seen as the growth engine of the future. And then lastly, we do see higher interest rates at the short end of the yield curve being very good for savers, meaning it's less of a problem to figure out what to do with our cash. Reasons for concern on the other side, the rising trade tensions, which we'll talk about in detail, could really have an impact on global growth. Even if it's just the uncertainty of what the future will look like, will affect business sentiment and investment. We have a flattening U.S. yield curve as the Fed raises short-term rates while longer rates stay pretty consistent. There are some concerns about a possible inversion in the yield curve, which has signaled recessions in the past. We've seen currency volatility, especially related to the first two factors above, which have impacted global markets. Then there's that looming question about whether or not we're in the late stages of our economic cycle. And this can be considered, not necessarily a real negative, but just a natural running of its course. And then lastly, the geopolitical concerns, where it seems like fights are being picked everywhere we turn in all corners of the globe. As mentioned, let's tune in a little more detail to the big issue on everybody's mind, and that is around protectionist tariff talk. Now, on the surface, enacting tariffs to protect American business sounds pretty cut and dried. And, those folks that don't pay close attention to the issue might think that it's a reasonable approach to helping our domestic businesses. But it's an extremely complicated story, and for the most part, one which leaves more losers than winners. As such, it has become pretty common knowledge that tariffs being a negative thing, we here in the U.S. have really tried our best to reduce these frictions as much as possible over almost the last 100 years. So over that time period, tariffs have basically declined with one notable exception, and that's the Smoot-Hawley, sometimes called the Hawley-Smoot Tariff Act of the 1930s, which by most measures, maybe all measures, was deemed a failure, including likely prolonging the Great Depression. Even Henry Ford told President Hoover this was an economic stupidity, and that is a quotation. And just to put that in perspective, you're talking about a U.S.-based business owner who is thinking that protectionist policies was ill-advised. And if you think about this for a moment, just in today's global business environment, just think about how much effort and investment companies expend in order to maximize their supply and distribution channels. And that's even according to or among stable economic environments. So that whole system has been upended. So, if we were business owners, major corporations, we have to wonder who would want to make significant investments in an environment of uncertainty. So that's sort of what we're all wrestling with right now. and it's already having an impact on the stock market. Just take two examples of large companies, which generally large companies derive more of their financial activity outside their home country than smaller companies, which tend to be more domestic focused. So let's take two examples of Boeing and Caterpillar, which do a lot of trade with China. And look at the far right side of this graph at what happened to their share prices as soon as retaliatory tariff talk escalated between the U.S. and China. And you see that their stock prices took a dive, and the S&P 500 did as well as a whole. So, and that's just from a business standpoint and from an investor standpoint. A more direct concern that we should all be thinking about as consumers and especially as financial planners helping our clients understand this environment is what tariffs on imported goods will do to the cost of all the stuff that we like to buy on Amazon. And I can attest to that. We have an Amazon package on our front porch almost every day. So certainly some of those things whose prices are reasonable, partially due to low production costs abroad, low tariffs, low barriers to trade, those types of things have benefited us as consumers, and tariffs can erode some of those cost savings over time. Now, it's hard to know exactly what the long-term impacts will be, but it's definitely something we want to keep an eye on. And it's difficult to say across the board that every one of our clients is going to be impacted in the same way. So we need to take a more nuanced approach in each case. Another interesting element of all this economic environment is that these stimulative policy measures can sort of be viewed as fuel on top of a raging inferno. One of the best measures of a healthy economy is low employment. And if you look at this graph, you see that ever since the Great Recession, when unemployment rose dramatically, we've seen nothing but a decline in the unemployment rate, currently at its lowest level since that time. And actually, some economists are thinking that our unemployment rate is on track to be at its lowest level since the 1960s. So, when you think about it, the economy is already really humming along. So when we have additional stimulative policy, in an already successful or growing economy, yes, it's good for U.S. workers, but if this fire is stoked any further, a major question is going to be basically where is the necessary labor going to come from to continue to grow this economy? And generally, when employment is so tight, or when labor is so tight, as they say, businesses would need to raise wages in order to increase their workforce, which can be another contributor to inflation. And we've already seen inflation moving higher over the past couple of years. And as the caption says, not to confuse higher inflation with high inflation. If you look at the scale of this chart, we're looking at inflation going from 1.4 or 5 to 2.2 or 3. And if you look at longer term history, you would have seen inflation averages more in the 3 or 3.5% range. So yes, inflation is creeping up, but certainly not at alarmingly high levels. And the next chart actually puts it in better perspective. So if we go back to the 1970s, since then we have seen inflation in the double digits. We've not seen that in a long time. And if you look at the far right side of the page, you see that inflation is well below that long-term average of 3 to 4%, which is reflected by the dotted line. Now, the one noteworthy number on this page is the cost, the energy inflation number, which in May came in at 11%. That means that the cost of fuel, specifically oil, has gone up by 11% over that time period. Now, that was due to some supply disruptions in Libya and Venezuela. Plus, during this period, this is when there were threats of an embargo against Iranian oil. Some of that talk has eased somewhat since then, but it does sort of go to show you that, different people have different sensitivities to energy-related inflation. Some people have different sensitivities to healthcare. Some people with college-age children have more sensitivity to inflation in education expenses. So overall, inflation has been pretty in check, but we do need to pay attention to some of those more individualized inflation numbers. So where all this economic talk starts really making its way into capital markets is in the conversation about interest rates. And what we're showing here is a picture of the yield curve. And you see this in every one of our quarterly presentations. So what you're looking at is basically the yield you would get on treasury bonds of various maturities. So looking from the 1-month treasury at the left all the way out to the 30-year treasury at the right. Typically, you see lower yields at the shorter end, higher yields at the longer end, basically compensating investors for buying a longer term treasury bond and tying up their money for a longer period of time, and that's something called the term premium. So what we're looking at here, the red line reflects the treasury yield a year ago, the blue line reflects the treasury yield more recently, and what you see here in this increase is that at the short end, the Federal Reserve is using short-term rates to, in this case, try to keep the economy from overheating. So they're raising rates to try to limit borrowing. If you make borrowing costs higher, you would have less borrowing, less investment. That would tend to put the brakes on the economy. But on the flip side of that, as the short end of the curve increases, you have that positive side effect of increasing yields on savings vehicles and short-term instruments. So if you have money market accounts or CDs, you're getting a better yield on those types of assets than you were in the past, which has been a problem for financial planners and their clients. Now, if you look to the right of the chart, you see less of a gap between last year and this year, and that's because yields have not increased proportionally for intermediate and longer term bonds. And that part of the yield curve is not as easily influenced by the Fed. That part of the curve is driven by the bond market, buyers and sellers of bonds. So right now, the market has not pushed longer term yields up, so we refer to this as a flattening of the yield curve. Short end is coming up longer than the long end, or higher than the long end, resulting in a flattening of that curve. And one of the most often cited measures of the steepness or flatness of the curve is the spread between 10 and 2-year Treasury bonds. And as this page shows, we are currently at a low point in the 10 to 2-year spread ever since the Great Recession. So one of the things you want to look at is not just, what happens when the spread is low, but what happens after that. And all of these shaded areas represent recessionary periods. So this is why the 10 to 2-year spread is such a most watched measure, because if you look, anytime that spread has become negative, which would indicate an inversion of the curve, where the short end is higher than the longer end, that has presaged a recessionary period. So folks are looking to see that that this curve does not invert, and if it does, does that mean that we're going to get a recession? Now, that's what everybody's squawking about, but we think people should just calm down. Recessions are pretty normal. Obviously, we've been through some pretty tough ones recently, and that's what's on everybody's mind. But as economies become more stable, we have to understand that our expansionary periods are growing longer. Our recessions in general are getting milder. And as we'll see later in our discussion on stocks, we're seeing valuations that are pretty normal. So it's not like we're sitting at all-time highs and a recession is going to cause a crash in market prices, whether it's stocks or real estate. I'm not saying that can't happen, but this environment doesn't seem to be as tenuous as prior potential recessionary periods. So now let's look at how all those yield movements have impacted our bond investments. And we have to remember bond mechanics, that when yields rise, bond prices fall. But we also have to remember that not all types of bonds respond equally. So for instance, if we just think about bond yields rising and prices declining, that relationship might lead us to believe that rising short-term yields would be disastrous or would have been disastrous for short-term bonds. But in fact, the higher yields on short-term instruments are more than making up for the smaller price declines. So for instance, in the second quarter, you have short-term treasuries, corporates, and munis actually with positive returns. And for the last 12 months, even though we've had this steepening or rise in the yield curve, it's only been the shortest term treasuries that are still showing a negative rate of return. By contrast, the smaller increase in the intermediate term part of the yield curve has had a bigger impact on bonds in the intermediate term category. So what I mean by that is even though yields haven't come up by as much, intermediate term bonds are more sensitive to those changes, so we see bigger price declines. Now, I said all of that, but we do need to keep in mind that this graph or this chart has a pretty small scale. So we're talking about changes in return plus or minus no more than 1.5%. So we just need to keep that in mind. So now most people would probably listen to that discussion and say, yeah, Mario, bonds are boring. Let's talk about stocks. So let's go ahead and do that. The big conversation on everybody's mind, at least in the first quarter and early parts of the second quarter, was around volatility. And when we say volatility, what we mean is the day-to-day increase and decrease in stock prices. And one measure that we use to data point that we use to measure volatility is the number of days in a year when the stock market changes by greater than 1%. And in this case, we've isolated the days when the stock market has declined by more than 1%. So if we look at the 70s, 80s, 90s, and 2000s, we see that we had 27 to 43 days each calendar year of price declines more than 1%. In 2017, we had a total of 4 days in the whole year when prices declined more than 1%. That has created a sense of complacency. A lot of market participants have gotten used to that kind of low volatility. So with a slight return to volatility so far this year, there have been a little bit more conversation and, dare I say, panic over that, but maybe it's a little bit overblown. We have seen 14 days in the first half of the year with price declines more than 1%, which puts us on pace for an annualized return or annualized number of about 28, which is consistent with the prior 7 years. Another way to put that into perspective is when we look at the largest intra-year drop of the market, and that's reflected by the dots towards the bottom of this slide, and the total return for each year representing the bars. So for instance, if we look at 1987, we know there was a huge price decline in the stock market of 34%. Yet, even with that 34%, the market was still up 2% for the year. If we look at 2009, 10, and 11, we also saw extremely negative periods of time, but yet in each of those cases, we saw positive returns, and in one case, we had a negative 19% number. We ended that year flat. So all this is really to say that we need to understand that, we are rewarded as market participants with the rate of return we can expect from stocks, specifically because we're willing to put up with this kind of volatility. So we need to sort of stop the panicking. We need to understand that markets will go up and they will go down, but that is the risk that materializes itself from time to time, and that is the risk for which we're rewarded as investors. So let's look at some category returns. And here, we're finally talking about a more normal scale, maybe even on the high side. If you think about long-term stock returns, we're typically around 10%, and here we are over the last 12 months with double-digit returns, specifically, even significantly greater than that. And let's start with the most prominent observation, this green bar here. And just to kind of clarify, these codes, if you will, at the bottom of the page represent different parts of the market. So R3000, for instance, represents the Russell 3000 index, which is essentially the whole stock market. The 1000 represents large and mid-cap stocks. G represents growth. V represents value. And then 1000 is large and mid, 2000 is generally small. So what this chart does is slice up the market between large and small and growth and value investments. The green bar over here reflecting large cap, large growth stocks, and their significant outperformance over recent periods. Now, I have to confess, I already mentioned Amazon. You know, not a day goes by that my family doesn't use something from Apple, Facebook, Netflix, Google, or Amazon. But I'm not sure that the prices of those particular stocks are really justifiable at these levels. Obviously, they're very good businesses, good enterprises. They have been the most successful stocks in the market. That's been driving the large cap growth index higher. More recently, you see this blue bar being the leader in the second quarter. That represents the Russell 2000 Value Index, which is a commonly used index for small cap value stocks. And that is an emphasis for us as investors. And it's nice to see small cap value as a leader as far as returns go for the second quarter. Outside the U.S., the major story is that emerging and frontier markets have really felt the brunt of the trade war talks. Generally, these countries' economies are the most susceptible to trade imbalances and are also sensitive to increases in U.S. interest rates. So it's sort of a potential double whammy. I will say that as investment managers, we are somewhat disappointed that, you know, Trump's U.S.-centric policies came at a time where there seemed to be an uptick in growth in these emerging and frontier market economies. And so these policies temporarily derailed the momentum that those regions were enjoying. That said, we're not abandoning our strategy there, and we feel that they will get back in the game in due time. It's important for us all to note that, you know, this stimulative policy that we're experiencing here in the U.S. will have to come at a price at some point. And a lot of people feel like we may have borrowed from future growth here in the U.S. So again, you know, we were talking over the last 18 months that when the U.S. economy started to slow down, we would be looking to some of these non-U.S. economies to pick up the slack. That did start to happen in 2017, but as I just mentioned, you know, these trade policies may have kicked that can down the road a little bit, and we'll be keeping a close eye on that. So that's your look in the rearview mirror, but the big question on everybody's mind is, where do we go from here? And in order to answer that question, we have to look at valuation. And by valuation, we mean a stock's price relative to some measure of its financial health. And on the left side of this slide, the measure used is forward earnings, or the expected earnings of the stocks in the S&P 500. The chart specifically measures the ratio of price to earnings of the S&P 500 and shows it at its current level of 16.1. Now, that is exactly on the 25-year average for the S&P 500's price to earnings ratio. So by that measure, we have no reason to believe that the U.S. market is overvalued, and we have no reason to believe it's undervalued. Outside the U.S., every other region is currently priced in a manner that looks like it's slightly or greatly undervalued, which means that at least relative to the U.S., we might be more inclined to justify investments abroad. Now, that said, we're not market timers. We just want to make sure that everyone is understanding of what the current environment looks like. Along the lines of not being market timers, we have to know that markets run in cycles and are unpredictable. Our job is to choose the optimal blend of a diversified array of uncorrelated assets, and you're seeing all of those assets for various time periods here on this slide. We need to understand that most of the time, as you're seeing in the second quarter and year to date, there are going to be some areas of the markets that are performing well. In this case, U.S.-based stocks, and then there are going to be other assets that aren't performing so well, in this case, non-U.S. stocks. And then we also have U.S. and global bonds here as well. I like to use the phrase diversification means always having to say you're sorry, meaning that it's almost impossible to choose asset classes that are always up. So if you're well diversified, you're probably going to have some parts of your portfolio that aren't doing that well. And over the long run, as you can see in the 12-month and 3-year slides, portions of the slide, the diversification makes for a much smoother ride. And holding on to that belief that diversification helps smooth out the ride and long-term perspective better helps investors meet their goals, we as financial planners really do focus on what matters in investors' lives, and that is to focus on the overall financial plan, focus on your client's long-term goals and objectives. Don't worry about beating benchmarks. Sometimes you will, sometimes you won't. Our job is to achieve our clients' goals. What we can do is pay attention to what opportunities exist in the marketplace and focus on reducing our investment costs, reducing our taxes wherever possible, and then continually rebalancing our portfolio back to our clients' risk target. And another aspect of that rebalancing is that we're able to achieve that age-old investment axiom of buying low and selling high. If we continue to rebalance our portfolio, sometimes counterintuitively, by buying into the things that are performing poorly, that will help us with that buy low, sell high type approach and give us a better chance at meeting our clients' long-term goals. So those are the prepared remarks for today. Any questions that you might have, you feel free to reach out to us, whether it's pertinent to the markets as a whole or specifically regarding your individual accounts. Thank you very much for your time, and we look forward to speaking with you again.